Hi, how's everybody? Hello?
Hello, Professor.
Good
Yeah,
afternoon.
hi, Yingyu.
Hello. Good
Hey, good
afternoon.
afternoon, Ravina. Ophelia, how are you? Hey, I only, spoke to three people. I mean, I see at least nine people here. Let me just check quickly how many are in, let's see. Okay, looks like we have 11 people so far in the discussion board. So two more shortly. I hope two more will be joining shortly. All righty. So let me share my screen. All righty. So we got a lot of things to talk about, and we are behind. As you know, we are behind. Of course, that has to be because the collaborate session is not the class. Okay, collaborate session is not the lecture. Collaborate session is only um, a reflection of the previous lectures. And just to show you where you should be as of today, right? As of today, um, we are in topic 3, right? Actually, we started on topic 3 on July 29th. Okay, so you should be. Why is it already something? August 2 will be available after August 2, 6 p.m. It's 6 p.m. August 2. Why is it not lighted? Oh, yeah. It's blue. So you should be caught up. You should catch up all the way to this video, okay? As of today. But we are still in topic 1, so how, how delayed, how much delayed we are, you can tell. So please, this is not the lecture, right? Collaborate session is not the lecture. It's just a reflection. We are reviewing, right? Um, Anyways, as of yesterday, you guys, submitted the second test in the. It's a self-test, as I said. Uh, the first and the second, the self-test about the ROI don't actually enter into the grade calculation, but they will help. They will boost, the lowest grade because the actual exam starts from quiz 1. Okay, to do quiz 1, we are like, if I give you, we're starting 3rd week. This is the 3rd week. Quiz 1 should be given before the end of this week because we'll have to do the midterm. I can't. 4th week. If midterm is given at the end of 4th week, I mean, if quiz 1 is given at the end of this week, and then midterm will be at the end of 4th week, and then there is quiz 2 and final. There will, and we have only 3 days or 4 days. I mean, last week they have to be all given out all together. That's gonna be a disaster. So no matter what, you should be caught up, all the way to today's topic. So let me quickly go over. Let me quickly review, because in our last class, it was sort of the discussions about inflation and nominal interest rate, real interest rate, I don't think a lot. I don't think. I don't think all of you got it right. So let me just quickly, summarize it. First of all, I'm not going to talk about anymore, that nominal interest rate is real interest rate uh, plus inflation. Okay, I'm not going to talk about that anymore. But let's think about this. Suppose, uh, first of all, people, what is inflation? Well, you can all say, you must know by now. I don't think anybody would. I don't think there is anyone who doesn't know what inflation is. Basically, sustained increase in price level across the entire economy. But then, generally, people have negative. Uh, People attach negative connotation to inflation. In other words, people generally think inflation is a bad thing. And I tell you, no, it's not necessarily a bad thing. I mean, there can be bad inflation, but also, generally inflation is a good thing. Why? What do you think is causing the inflation? What do you think is the cause of the inflation? There are largely two causes of inflation, right? Of course, it's demand and supply, of course, but now let's think about it. What causes the inflation to go up? I mean, what is the cause of inflation?
Inflation. The price for the items actually going up, so like the materials and stuff that are required to make things.
I can't. Okay, can you speak up?
Okay, can you speak up?
Yeah, so the cost to make the item. So for example, if the production cost goes up, then we can have inflation.
Well, one thing
is the cost.
Why do I hear my voice back? It's louder than your voice. So I think somebody's somebody's microphone is turned on, and but who said that? Was it Safia? Who said that?
Who said that?
Yeah, it was me.
Who is me, Safia?
Who is me, Safia?
Yes.
Okay. Now, yeah, that's true.
Yeah, that's true.
So that is called, input cost, right? Input to production. Input means, input to production. But what are inputs? There are largely three inputs of production, right? Largely three inputs of production: labor, capital, and raw material. Labor, capital, raw material. Sometimes raw material is called natural resource, right? Of course, raw material comes from natural resource. But think about it. Then, yeah, cost of the input goes up. But then why does the cost of input go up? Why does the cost of input go up? They just go up for, no apparent reason. They just go up. Now, please speak, because if you type into the chat box, I don't, Ophelia, you said that, but my question is that always think about the cause and effect. Huh? Price of the manufactured goods will go up. Price of the manufactured goods, final products would go up because the production cost increases. right? But then what makes the production cost go up? Think about it. Production cost doesn't just go up out of for no reason. I mean, there is something that, yeah, Abul, go ahead.
Because the consumers are willing to pay that additional cost.
That's right. That's the answer. I told you. I said production cost means cost of input, right? Input. I said I've been telling you it's the input. Input cost goes up, and there's no input cost doesn't go up for it must go up for a good reason. I mean, it doesn't go up just for fun or out of no reason. You understand? And input means labor, capital, and natural resource, raw material. In economics, economics clearly defines. We don't need unorganized, cleaned verbiage. In economics, everything is very concise, right? Labor, capital, and natural resource. Think about it. Everything falls under it, right? Everything falls under, this is the broadest categories of inputs, labor, capital, natural resource. Everything, no matter what, small things like, they all fall into that, right? So but then the reason, and who said that? Abul, was it Abul?
Yes.
Okay, Abul. Okay, so you got 0.25 for that. Consumers are willing to pay for that. What does that mean? Consumers are willing to. I mean, consumers demand it, right? Consumers demand it. In other words, even if the input cost, production cost goes up, so the output price of the output goes up. If that price increase discourages the consumers, then price cannot go up anymore, right? If I feel burdened by increased prices, I'm not gonna buy that anymore, right? I mean, there's a certain, and it all depends on consumers' income. If you think about it, isn't that right? If for example, I want to buy, let's say my income is the ultimate constraint, isn't that right? I want to buy a Porsche, or I want to buy a Lamborghini. I don't like Lamborghini. It looks ugly to me. It's not aesthetically appealing. But Porsche is good. Porsche is aesthetically appealing. But how much is let's say $100,000, a Bentley, $100,000. I want to buy a Bentley, but ultimately it's my income, right? That works as a constraint to my consumption. But if my income doubles, for example, if my income doubles, I may be able to afford a Bentley or a Porsche or Porsche. So think about it. Price goes up because the demand supports it. You understand? In other words, inflation is caused by strong demand. Strong demand. If the demand is weak, price cannot go up. Right? Makes sense? So what does that mean? Strong demand can only be possible, as I said, strong demand can only be possible with increasing income. Only your income, as your income grows, then I mean, your paycheck goes up. Your paycheck, annually goes up by 10%. And annually 10%. That's a very good thing. 2 years later, it's 21% greater than, right, 2 years ago. So my consumption will grow, so demand will be strong. I mean, think about it. So the first cause of inflation is strong demand, and strong demand is caused by greater income, higher income. You understand? So this is you must, if you study economics and finance, something you will, the first thing you realize is that it's all about the causality. What causes what? What causes what to happen? It's trying to explain the causality, right? It's not just in economics and finance, we're not talking about, this is that, that is this, A is B, B is, C is D, it's not that. It's all about A causes B, hence B causes C, right? Which causes, it's all about causality, trying to, explain cause and effect. And if you don't understand the cause and effect, and think about it, everything that we have talked about, I have been explaining so far, is all about causality. Why? Federal Reserve, open market operation, how that raises, lowers, raises or lowers the interest rate. It's all about the cause and effect. The mechanism of cause and effect is the causality mechanism, right? So think about it. So if there is inflation caused by strong demand, which is caused by higher income, isn't that a good thing? Isn't that a good thing?
Yes.
Yes, it's a good thing.
More money.
Yeah. Not only more money. What that means is the economy is getting bigger. Economy is big. Economy is gaining, right? Didn't I tell you GDP is called, gross domestic product, which is, in other words, national income, right? But, that means output of the economy, output of the economy, right? And then I tell you output is the same thing as income. I mean, output redistributed onto everyone in the economy, output of the economy redistributed onto the economy itself, right? That's the income. So when your income is growing, and that means across the entire economy. I mean, on average, everybody's income grows by 10%. What does that mean? That's on average everybody's income. That means output of the economy, national income is growing, GDP is growing by 10%. That's why that's average, right? That means output of the output capacity, production capacity of the economy grows by 10%. Same thing, right? So the output of the economy is growing by 10%. Size of the economy is growing by 10%. Make sense? So here's another concept that G stands for what? Growth rate. Okay? Let's say that's economic growth rate, right? Economic growth rate. So if inflation is caused by strong demand, which is caused by growing economy, right? Growing income caused from growing economy, it's a good thing. So it's not necessarily a bad thing. On the other end, inflation can be caused by too much money supply. that stands for money supply, right? Money supply exceeding money demand. There's a lot more money than demand for money. Now, of course, think about it. If the economy is growing by 10% a year, of course, then demand for money would also grow by, about 10% a year, right? Isn't that right? You need, because the economy is, growing, right? Money demand grows too. But if the economy is not growing, but there is, too much money supply, then everything will be more expensive. Now, think about. Let me give you a good example. Let's say this economy grows only apples. We are living in a small, closed economy where the only output, only product is apples, right? And in this economy, there are like 10 people. And so it's an agrarian economy based on land. So mainly, it's just agriculture, right? And mining could be agrarian, but let's say just agriculture. And just, apples. And there are 10 people, and each individual in this economy is tending to 10 apple trees. So that means, so apple trees are like, production equipment. I mean, that's the engine of, the economy, the only engine of this economy. And then, because 10 people each, tend to 10 apple trees, there are like 100 apple trees. And let's say there are these apple trees, on average, each apple tree bears 1,000 apples. 1,000 apples, right? So at harvest, right? At harvest, there are 100 trees, each bearing 1,000 apples. 1,000 apples, that's too much. I don't know. There will be, total of 100,000 apples, right? That's the output of this economy. And of course, if people cannot consume only apples, but we just assume that they all, consume, apple is the only thing they need. They eat apple, and then they trade apple. After eating what they need, they trade, with their neighbors. Of course, if the apples are all of all the same kind, then there won't be any trade. Assuming that apples are all of different varieties, right? Green apple, red apple, yellow apple, whatever, all different varieties, then there can be trade. But the thing is, let's say we introduce. So until now, it's basically a barter economy, barter. They just trade with each other. 10 green apples with, there could be some difference in exchange rates. It may not be all equal. It's not like one green apple for a red apple, or it may not be like that. It could be 10 green apples for one red apple. I mean, if they all, it depends on whether they prefer red apples or. But anyway, let's not make it more complicated. Let's just assume one apple for one apple. Now, so there are 100. Let's just make it simple. Let's say there are 1,000 apples, in the economy. And now think about it. Apples do not last very long. This is, an agricultural produce, so it may not last. The storage, right? If you cannot store the apple for a long term, right? They all perish, right? So there's no, and to trade apples, then they have to bring it to the marketplace, but then there's no cold storage, so the apples will perish, in a matter of weeks or days. So, but it's not like everybody wants apples every day. I mean, one day I may want green apple, but another day I want red apple, and this doesn't necessarily happen every day. I mean, market doesn't open every day. Maybe market is market once a week. The market opens once a week or once a month. Now during this period, they have to store apples in the cold storage, and then think about it. I don't want to make the story, thought experiment more complicated, but let's say because of the, but you can buy, you wanna buy the apples in advance because you can't wait until the market opens. So you call the red apple your green apple guy, but green apple producer, but you want to buy red apples, and you want to lock into a contract before anybody else comes along and whisk away all the red apples, sweep away all the red apples. So and the delivery can happen later, but you want to lock into a contract. So what do? You have to pay money. I mean, previously you didn't, you just trade. Now you need money, right? Because to make a contract, to sign a contract, and secure the apples ahead of time in advance, you have to make a contract, write up a contract, and pay down payment or something. Look, so what I'm trying to say is, let's introduce money now. So if there are 1,000 apples or 1 million apples, right? Let's say 1 million apples. There are 1 million apples. Then let's introduce, $1 million. If there are $1 million and 1 million apples, what should be the price per apple? Anybody? If there are $1 million and 1 million apples, what should be the price of apple?
$1 apple.
$1. Yeah, $1, of course. And I'm sorry, I can't give you any points for that because this is yeah. I mean, it's only weird. It's only surprising that other people didn't even say anything. I mean, this is not even any challenging, thing. Okay. Now, so the next year, at the harvest, there was a productivity increase because they developed, some agricultural technology. They used, a good fertilizer or some, agricultural technology that increased the output. So there was a productivity gain. So next year at the harvest there are 2 million apples. 2 million apples, right? But let's say the money supply didn't increase. There is still just $1 million. So what should be the price per apple then? There are 2 million apples, and the money supply in the economy.
50 cents?
Yeah, 50 cents. Who said that?
Sophia.
Okay, Sophia, 50 cents. Okay, all right. I will give you, 0.25 because sometimes some people say $2. That's, and you think it is silly, but that really happens. Sometimes there are just 2 million apples and $1 million. Then they say $2. That's ridiculous, right? Now, yeah, the price went down because there was more, less supply of money. That means what? let's do the opposite example. So another year, the output, the harvest at apple harvest, right? There are only 1 million apples, but by mistake, they injected $2 million in the economy. $2 million in the economy. So then what should be the price per apple? What should be the
$2
price
per
per apple?
apple.
$2, yeah, $2. So, so think about it. In this case, you have $2, but you have $2 million and but 1 million apples, so the price per apple is $2. So the price just went up, price doubled, not because not because of the demand, not because of the growth in demand, but simply because there is too much money supply, right? Now, another scenario, right? So, thanks to the productivity gains, they have 2 million apples, and then they injected $2 million into the economy. So then what happened? What was the price per apple? There are 2 million apples and $2 million. What's the price per apple? Anybody? This is no brainer, and nobody's saying anything. 2 million apples and $2 million, huh?
Would it be one?
What should be huh? Say that again.
Would it be one per apple?
Yeah, $1 per apple. Yes. In other words, the price doesn't change because money supply exactly matched the money demand. In other words, money supply caught up with the output growth, right? So it is also, you can think of it this way. If money supply exceeds the output growth is, in other words, what? Economic growth rate. If money supply exceeds output growth, then the price will go up for no good reason. It's just, due to, that's inflation for no good reason, right? So here's the thing. I've been talking about, it's all because of, demand and supply for money, right? Now, demand for and supply of money, right? Strong demand causes, this is a good case of, inflation, because it means strong demand for money. Why strong demand for money? Because the output has increased, meaning, economy has grown, right? But just because the demand is strong, does that justify, what's that called? Haywire, or unbridled inflation. I mean, just because the demand is strong, does that justify, unbridled, skyrocketing inflation? No. Usually, good inflation, I mean, Federal Reserve has clearly defined what is desired level of inflation. According to Federal Reserve, desired level of inflation is about 2%, right? 2% inflation is basically good for, is a sign of strong economic growth, right? Strong economic growth will cause, strong demand, because income goes up, and the inflation caused by strong economic growth will be about 2% in case of U.S. economy. And the other case is, excessive, money supply, right? And that's a bad case of, inflation. So if this is about 2%, that's good, that's fine. But then it's, so here's the thing. How do we know, so if Federal Reserve's, inflation target is 2%, right? That means if, let's think about it, between economic growth and inflation, there can be three possibilities. Economic growth being greater than inflation or equal to inflation or less than inflation, right? So if economic growth rate is greater than inflation, let's say inflation is about 2%, but economic growth rate is 3%, 5%. This is what Federal Reserve wants. This is what a strong growing economy, expanding economy is showing. But if it is the other way around, if it is the opposite, that's a bad thing. Why? First of all, think about it. Economic growth rate is 10%, and if inflation is 5%. Well, this is still, even after adjusting for inflation, right? Even after adjusting for inflation, the real growth rate is still positive, right? 5%. In other words, there's a net gain, even after adjusting for inflation, there's a net growth in the economy. Make sense? On the other hand, suppose, it's the other way around. Economic growth rate is 5%. That's a good growth, but inflation is 10%. Obviously, net growth is negative, right? Real growth rate is negative. Now, just like real interest rate, nominal interest rate, this is we can think about nominal growth rate and real growth rate, which is so think about it. If your paycheck, if your salary goes up by 10% every year, right? And even if there is a 5% inflation, right? No, will you be crying out inflation when your salary goes up by 10%?
No.
No, you won't cry out. You won't cry out, because you're still better off. You're still 5% better off than a year ago, right? You can spend 5% more. I mean, everything is 5% more expensive, so you cannot spend 10% more. In real terms, you can spend 5% more. I mean, you can buy 5% more. So still, because of the positive gain, nobody will even sense there is inflation, right? When inflation and growth rate and inflation are equal, when they are both 10%, right? Then what? There's no net gain, right? There's no net growth. Your paycheck is 10% more than last year. Let's say last year you made, $10,000. This year you made $11,000. Well, you can tell, there's no net gain because Coke, in terms of Coke, last year it was $1 a bottle. This year $1.10. Last year, with your annual salary, annual income, you could buy what? 10,000 of them, right? This year, you can still buy. Your salary is 11,000. You can still buy 10,000 bottles of Coke, right? So you're not better off, but you're not worse off either. So you won't cry out inflation. You just, wonder, well, it looks like my salary went up by 10%, but how come I cannot, I mean, nobody would be exactly, calculating that. But, if you are like counting pennies, or if you're watching your spending, your income and spending, right, you would have noticed, my income went up by 10%, but how come my purchasing power is not 10% more? But still, nobody cries out inflation. But if this is the case, growth is negative. In other words, yeah, now you understand. Nominally, your paycheck is 5% more, right? But your purchasing power is actually 5% less, right? Roughly now. So, so again, so think about it. Making adjustment, if you want to make adjustment for inflation, right? That's, see, price, because price at time 1 is price at time 0 times 1 plus inflation rate, right? That's what we did to find, this year, your salary is 10.5K, right? Because of 5% growth, right? But what can this 10.5K buy, right? How much can this 10.5K buy? You'll have to divide it by, right? You'll have to divide it by inflation to get to what it can buy, right? In terms of real goods, like bottles of Coke. Now think about it. If there, in this case, inflation, although there is 10% inflation, actually, net effect is 0, right? If they are the same, growth rate and inflation are the same. Try that here, like this. If that's the case, then what is that? It's 11K. Your salary is 10% more, but if you adjust it for inflation, right? Because it's you will get exactly 10K, which can buy 10,000 bottles of Coke. Make sense? In other words, with 11K, you can only buy what 10K could buy last year, right? With 11K, you can buy only 10,000 bottles of Coke, which is what 10K could buy last year, right? So this is simply, this explains why, when we make adjustment for inflation, that's why we divide it by 1 plus inflation rate, okay, to convert it back to, what it could buy in real, in terms of, that's what purchasing power means in terms of real goods, what it could buy, right, a year ago, right? I mean, and that's what it can buy now. In other words, with 11K, you can buy only 10,000 bottles of Coke, which is what, and now it would be much even lower, I mean, if bottle of Coke is $1.10 because everything got 10% more expensive, and your paycheck grew only by 5%, it will be, obviously, you cannot even buy what, $10,000 could buy last year, right? Now, so that I hope that has, that has cleared up. That took 1 hour. And the next thing, we need to move on to the next topic because I want to. Next thing is yield curve. Now, yield curve is actually, what does yield curve mean? Yield is what? Yield curve looks like basically yield means what? Yield is another name for rate of return. Yield is another name for rate of return. And it's different from interest, right? It's different from interest rate. Now remember, in case of bond, right? In case of bond and everything. Now I used the house value example. Any financial assets have two components: capital gains and income. Remember that? Does everyone remember that? Anyone? Yeah. Okay, only one person. What happened to the others? I see, 13 people participating. Somehow, yeah, there's a gain that you get from price increase. It could be decrease, so it could be capital gain or capital loss. And then there's incidental income that comes from, that is generated from, that financial asset, like, or that capital asset. So in case of house, right? If you're renting out the house, the house value. I mean, if you sell it 10 years later, there's a house value appreciation, right? The gains from house value appreciation, or it could be, it could be other way. It could be house value depreciation, and there is income from rental, right? If you rent it out, well, those two portions, right? And if it is bond, right? Remember, and we're talking about the coupon bond because only coupon bond has both capital gains and income portion. Zero coupon bond has only capital gains. Zero coupon bond will only have capital gains. So if you think about it, and let's think about bond. Bond as and bond. The source of return for bond is, right? So ROI. This is so this is so annoying. The return on the bond, right? ROI. Or simply, I can call it simply, yield. This is yield. So, where is it? So, two sources of return on the bond is capital gains and coupon interest. Coupon is the interest the bond pays, right? And you might wonder, why is it called coupon? There will be a time, for explaining it, because there's a separate topic about dedicated to bond. So think about it. Bonds coupon rate. So this means coupon payment. So this is in dollars, right? This is also dollars, right? Coupon interest, of course, that's percentage, right? So if you think about it, if you put your money in the bank, there's only interest, right? You understand? There's only interest. You put $10,000 in the bank, right? Put $10,000 in the bank at 10% interest rate. You keep it for 10 years. The future, your principal doesn't change. It's 10,000, and over 10 years, the interest will accrue. It's going to be 1.1 raised to 10th power. But in case of bond, there is only interest, coupon interest, but also capital gains or capital loss. Why? Didn't I tell you, we already discussed this. Bonds don't sell at face value, right? Face value of the bond is $1,000, right? Back in the 1940s, face value was $100. Now it's all, face value is $1,000. And I told you, face value is the maturity value. At maturity, they give you 1,000. Okay, but the price they sell for today. So if it is a 10-year bond and paying, let's say, 10% coupon interest, and then with 10 years left, it may sell for $800, or it may sell for $900. So in other words, and the reason they sell below par value is because the coupon rate they pay is lower than the prevailing market rate. Well, then in that case, there will be capital gains, right? Because you pay $800 and at maturity, you get 1,000. And during this timeline of 10 years, you collect $100 every year, okay? But paid in semi-annual coupons, so $50 every 6 months, okay? So if you think about return on the bond, remember holding period return has these two components, right? Capital gains and sum of all these coupons, right? Sum of all these coupons, which is, coupon. And then you divide it by price. You divide it by price at time 0, right? Makes sense? Now, then you annualize it. How do you annualize it? You forgot already? How do you annualize it? Huh? Anybody? How do you annualize this holding period return? How do you do that? I should apply, a penalty across the board, everyone. Huh? How do you annualize holding period return?
Don't you find a geometric average?
Yes. Who said that? Who said that?
Mohammed.
Mohammed. Okay. Yes, Mohammed. Yeah, you have to find a geometric average, right? Geomean, right? Geometric average, right? Then that's called what? That's called yield. Okay, so yield is in other words, yield is nothing but annualized return. Yield is annualized return. Okay, and it's clearly different from interest because interest is only this part. That's the interest, right? Right? That's the interest. So yield curve means, the curve that is the curve that results from connecting annualized yields of different maturities. And you can easily understand now. Yeah, where is this thing? I mean, how do I get? Okay, I don't like this. Okay, I made it go away, but then this toolbar came out, which minimizes the viewable area, but that's okay. So look, the yield. What did I say the yield curve is? Yield curve is basically connecting the yields of bonds of different maturities from short term to long term. And so look, this is 90-day T-bill, let's say Treasury bill, right? 90-day T-bill, and they generally watch the Treasury yield curve. They generally watch Treasury yield curve, and 90 days, it's 3 months, right? And there was 1 month even, and then 1 month yield would have to be lower, and 1 year yield should be greater than 90 days, and and so on. 90 days is also 13 weeks. I told you 3 months is 13 weeks. And this blue curve is the normal yield curve, and it makes sense. Remember, as the maturity gets longer, remember in the last class we talked about maturity risk. What does maturity risk mean? Anybody remembers that? What's the maturity risk?
The longer the life of the holding, the more of a risk it is.
Yes.
So we need to
And
pay
who said?
attention.
Yeah. The longer the maturity, the riskier the bond is, right? And that's only obvious because there's a lot of uncertainty. Right? The longer the timeline, the farther into the future, the further into the future you go, we don't know. I mean, who would have ever thought, even 2 years ago, even in 2018, I mean 3 years ago, who would have ever thought? I mean, even early, who would have ever thought we would be hit by this pandemic, right? Which was completely unpredicted. It was unpredictable, right? Who would have ever thought it would have a global impact, right? One good thing is, we didn't go into any, recession because, the federal government, Federal Reserve, uh, uh, continued with, zero interest rate and, expansionary monetary policy. And even the federal government went into expansionary fiscal policy. There was a lot of, there was a couple of days ago, there was a New York Times article or Wall Street Journal article that a woman who used to make like, about $20,000 a year before the pandemic, working full time, made three times $60 something thousand dollars, not working. So how could that happen? So much subsidies, so much subsidies from the government. And of course, there's big controversy about it because, anyway, this what's that called, economic stimulus check. Stimulus check isn't for free. Now they, send you the check, but later it will have to be restored. I mean, because government is, debt spending. Government is, doing this by taking on debt. So eventually it will have to be paid back by the
It comes out of your
tax
taxes
revenue.
when you file it.
Huh? What's that?
It comes back out of your taxes when you file it.
Yeah. It comes out of your. But then look. That's why the Democrats have proposed, increase in tax increase only on the wealthy, top 1% wealthy, and the big corporations that have evaded tax for a long time.
I think that's a good option.
Huh?
I think that's a good option because when we're older, by the time we're
Yeah,
25,
of
the taxes
course.
will be increasingly high for us.
Yes. In other
We're
words,
making minimum wage.
but there was a very strong resistance from the Republican side. Okay, and Republicans are always, they are. I'm not going to get into that. They are for
They're
small
very
government.
conservative.
They don't want to. What?
They're very preservative.
They what?
They're very preservative.
Preservative?
Yeah.
What do you mean? You mean
Of themselves.
conservative? No. Conservative is not. That's not. Look, it's not conservative. I mean, they are just. You know what? They Republicans get paid by the get lobbied by the wealthy, top 1% wealthy, and giant corporations. So they try to defend the interest of the wealthy because they are largely, very funded and lobbied by the wealthy. Okay, they say, small government is a good thing, so they cut taxes for giant corporations. I mean, they made all these. So while Donald Trump was, in the office, the GOP and the Congress was, dominated by GOP, the Republicans, and they passed the law to cut taxes for the wealthy. You remember, 2017 or 2018, Donald Trump knew, tax law was legislated. And it was like as if, it was saving taxes for everyone. No, someone like me in the middle class didn't get that much, tax cut. It's mainly the top 1% wealthy and the giant corporations. In other words, Donald Trump served himself basically, right? And Mitch McConnell, the Senate leader, Mitch McConnell, Senate, GOP leader, and all the Republicans, basically, they all, and they are called red states. The red states, Republican states, red states, they are the ones that are struggling because they have no, they don't have that much in it because industries are not located in the not much industry. Not that much industries are not that many industries are located in the red states because it's like middle of like Kansas. It's like middle America, Kansas. I mean, when I say middle America, not just middle class America. I'm not talking about that. Like deep South, Bible Belt, inland, not coastal areas. Usually, coastal areas, are East Coast, West Coast. Coastal regions are Democrat, and there are more industries, more businesses. Anyway, the red states are the ones that are suffering the most, from the Donald Trump's tax cut, and even from COVID-19, because vaccination is the lowest. Vaccination rate is the lowest in the red states, in the Republican states, right? Okay, too much of that. I don't want to digress, but again, so back to so you remember, because of because the uncertainty is the risk, the longer the maturity, the greater the risk. So long-term bonds have to pay higher return than short-term bonds. That makes sense, right? That was what we talked about last Thursday. Maturity risk, all the risks, I mean, it's an incentive, right? For it's an incentive to attracting investors to buy long-term bonds. I mean, if the long-term bond yield or the return on the long-term bond is the same or not significantly higher than the short-term bond, long-term bonds will always lose to short-term bonds, right? Makes sense, because who's going to invest? I mean, if the the returns are the same, what would you do? I mean, over 30 years, think about it. And when I say yield, that's annualized return, right? So that means, annualized return of a 30-year bond, if that is the same as 1-year bond, right? Who's going to hold a 30-year bond, right? I mean,
Nobody.
think about it. This is a very straightforward and rational thinking. I mean, if there's no difference, I mean, 1-year bond, 30-year bond, they all have 5% annual return, right? 5% yield. What would I do? There's no reason to put my money into 30-year bond. I would simply put my money into 1-year bond and just roll it over 30 times. Don't you think? You understand what I'm saying?
Yes, Professor.
Yes.
Yeah. In other words, I will put my money into 1-year bond, and 1 year later, I redeem it, then put it again into 1-year bond, another 1-year bond. I do this 30 times. I roll it over 30 times. Right? What's the difference? It will still be the same thing. So the only, and then 30-year bond will 10 out of 10, 10 cases out of 10 will always lose to 1-year bond. Makes sense? So, and obviously that's why 30 longer term bond has to pay higher yield, right? Of course, yield is not a fixed thing. Think about it. Yield is not a fixed thing. It changes, daily, right? Why? First of all, at least it changes every 6 months. Why? And it changes every day. But why? First of all, 1 year. Think about it. 1 year passes. We have a 30-year bond, and let's say we are at time 0. But 1 year later, we will be at time 1. When we are at time 1, how many coupon payments are left? Now, at the beginning of at time 0, with 30 years left, right? At time 0, how many coupon payments are left? In other words, how many interest payments are left?
At time 0, 30. At time 1, 29.
What? Say that again. At
At
time 0, how
it's
many?
30, because it's the start.
30, yes. 30 interest
And at
payments,
time
30
1,
annual.
it's going to be 29.
At time 1, there will be 29, but don't go too fast. I told you, yes, 30, that's correct. But, what did I tell you? Interest is paid annually. Interest on the bond is paid annually. Huh? I told you interest on the bond is paid semi-annually. That means twice a year, right? If the coupon rate is 10%, you'll get $50 every 6 months, right? Not $100 at the end of the year, but you get 50-50. But you might say, oh, doesn't matter, because anyway, at the end of the year, it's going to be 100. It's going to be equal to 30 annual coupon payments. Yes, it's going to be equal to 30 annual coupon payments. But it's important to not to forget that coupon interest is paid semi-annually, because later in valuing bond valuation, that semi-annual time frame is very important. Okay, that's going to make a difference in the valuation of the bond. Now, yeah, think about it. And when you have 30 coupons left, when you have 30 interest payments left, it should be valued. It has more value, don't you think, than when it has only 15 interest left. Does that make sense? Right? Don't you understand? I mean, when bond pays 10% interest annually, and with 30 interest left, 30 years left, with 30 interest payments, left, each interest, annual interest, $100, with 30 of them left, it is worth, obviously, it factors into the valuation, because more interest payment means, more value at time 0, and as time goes on. I mean, obviously today, something with 30 interest payment is worth more than something with 15 coupon payments left. You understand? Nobody understands? Ah. Look, if I have, of course, that's not the only factor in valuation, but the reason I'm okay. So what I'm trying to say is the coupon payments are a big factor in valuation of the bond, right? How much? Obviously, 10% coupon rate is preferred to 5% coupon rate. That goes without saying, right? And how many coupons are left is also an important factor. More coupons left would is more favorable than less coupons left. But anyway, the idea is normally so annualized returns of the long-term bond should needs to be greater than annualized return on the short-term bond. And I explained this. If that is not the case, then I will just simply buy 1-year bond and just roll it over 30 times, right? So it only makes sense that the when we connect those yields of 30 days, 90 days, 180 days, 1 year, 2 years, 5 years, 10 years, 30 years. When we connect that, it will show this upsloping curve, right? Does everyone understand? Everyone follows?
Yeah.
Come on. Okay.
Yes. Yes. You're following.
Yeah. So that is called, normal yield curve. And there are many theories. 4 theories. I didn't put fourth theory here because theory is about the yield curve. That means why yield curve uh, uh, shows that upward sloping pattern. One is expectations theory. The other one is liquidity preference theory, market segmentation theory, and etc. It's actually unbiased. That's expectations theory. Okay. So we don't have time to go over this. I want you to. I'm gonna throw some links in the chat box, which will explain why. Which will explain these theories behind it. But the idea behind it is I mean it's easy. No matter how you explain it, it's clear. You have to pay higher return. Of course, as I said, the reason I was going over all that, how many coupons are left, is that the yield is not a fixed thing. It changes every day because the price changes every day, pricing changes every day, and the reason they change every day is because, of course, demand and supply, but also, even if there is no change from demand and supply, because of the interest payment left, coupon left, number of coupons left, right? That affects the valuation. So valuation changes at least every 6 months, right? Other than that, valuation changes every day because of the demand and supply, and a lot of other factors like when Federal Reserve says something about raising interest rate or oh, here's the thing, when they say okay, but interesting thing is sometimes you observe inverted yield curve, inverted. Why does that happen? How can that there be inverted? I mean, this is defying uh, our common sense and our logic. Why? Because this means short-term bonds pay you higher yield. Short-term bonds pay higher yield than long-term bonds. How can that be? Hmm? And we're
That
not
means that
gonna.
the economy is about to go. They're gonna have some sort of recession or depression.
Yeah. This is a signal of impending recession. Inverted yield curve is a signal of impending recession. But why? Why this is a harbinger? or forebearer of, recession. Why? So it's always about why, right? Remember, it's easy to just memorize, inverted yield curve is a sign of impending recession, but without knowing why, without being able to explain why. Mhm. And what did I say? Economics and finance are all about causality, explaining why, what causes what to happen, why X causes the change in Y. Why change in Y causes change in Z. I mean, this type of explanation, explanation of causality, cause and effect, right? That's what economics and finance is all about. So, okay, so why is this happening? Now, think of it this way. So, suppose, the market it's a wide held belief in the market that the recession is impending, imminent. And imminent means what? It's in the short-term horizon. It's in the short-term horizon, not in the long-term horizon. I mean, if the recession, is there anyone who can forecast, a recession 10 years later? No, there's no way of knowing with accuracy whether there will be a recession 10 years later. And even if you can forecast it, it's still 10 years later or 30 years later. It doesn't, things will change before we get there, right? Things will change. The whole economic situation will change before we get there in 10 years or 30 years. I mean, so there's no way of, predicting with, certainty, 100%, accuracy and certainty that there will be, but, or even if you can predict recession in 3 years, we can take action before that, but if recession is in the short-term horizon, and that means within 1 year, within 6 months, within 1 year, I mean, if it is imminent, what are you gonna do? I mean, what's gonna happen? Are you going to? So the first thing, if you have suppose you have $1 million invested in a 1-year bond, right? Or short-term bond, right? Like 6 months, bond maturing in 6 months. Okay, you put $1 million in short-term bonds, right? Short-term bond, and it's going to mature within 1 year. And within 1 year, recession may hit. And if recession hits, what's going to happen to my short-term bond holding? Can anybody tell me what's going to happen to my short-term bond holding when recession hits? Now, what you need to think about is the company. This company that sold the short-term bonds, and the company whose
The bond
bonds.
value will go down, so your money's going to be worth less.
No. Hold on. Before you jump into that conclusion, let's think about it in chain reaction. One thing causing another, and causing another. Let's think in terms of chain reaction first. Okay, that's important. That's everything. Because we need to understand the mechanism that causes all these things. So we must think in terms of chain reaction. Understand? So the company that I'm holding their short-term bond of, right? What's gonna happen to this company? This company won't this company be in jeopardy, right? Because if it's not only my 1 million, if this company has like $10 million in short-term bonds, or even $1 billion in short-term bond, think about it. What do they owe me? They owe me one or two interest payment, one or two. I mean, depending on how much time is left on this bond, right? If only 6 months left, one coupon. If still 1 year left, two coupon payments, right? You understand? And then principal, payback principal. And they owe me, $1 million in principal. And if they owe me two coupons, at 10% interest rate, then they owe me $100 per bond, and 1 million means almost like 1,000 bonds, right? So $100,000. So if this company is no matter whether this is a big company or a small company, right? Big company or small company, AAA, whether this is a AAA company or triple B company, it will be difficult all the same. I mean, it will be harder to pay back, right? During the recession, it's going to be a lot of companies that owe them money can default. This company can also default. I mean, if they have $1 billion in bond, right? So they have debt of $1 billion, and suddenly, they have to make this payment within 1 year, and recession hits within 1 year. During the recession, their business isn't doing well, and the companies that owe them money, their businesses aren't doing well either. So the chances of their profit, right? Chances of their profitability will go down. As their profitability goes down, their profits go down, then they will have less chances or more difficulty to come up with that $1 billion. Do you understand? They will have more difficulty, no matter whether it is triple A company or whatever, small company or big company, they all have difficulty. So the chances of this company defaulting on your debt, on the bond that you're holding, will increase. Does that make sense? So what do? Do I keep holding this short-term bond? Do I keep holding this short-term bond?
No.
No, you don't keep holding this short-term bond because it might default. So what do? You dump this short-term bond. That means sell, right? That means sell, right? And it's not only you. A lot of people holding, a lot of companies and institutional investors and individual investors holding this short-term bond will dump this bond. And when you dump something, what's going to happen to the price? What's going to happen to the price when you dump something?
It will lower.
Yeah, price will go down. And who said that? Who said that?
Gabriel.
Gabriel, yeah. Look, this may not, so you'll get 0.25. Yeah, it's a very logical thinking, right? Because you might think it's not it's not a challenging question, but being able to think like this, this must be like your second nature automatically. Of course, the price will go down. So if the price goes down, and then after they sell, what are they gonna do? they will move this money. They will move this money into long-term bond. Will move this money into long-term bond. Why? And you might wonder, oh, because of recession. So yeah, you can sell short-term bond because in 1 year this company will have to within 1 year. I mean, it doesn't mean necessarily just exactly in 1 year. A recession may hit any time within the year, and this bond will mature within 1 year. It could be 6 months, or it could be in 9 months. It could be in 3 months. But if the recession hits, the company will have a hard time. The chances of default will go up. So what you do is then, you sell and you move that money you put that money into the long-term bond. And why? Because long-term bond, suppose you move your money to the 10-year bond or 30-year bond. If you move your money to 10-year bond, what's going to happen? First of all, the reason you do that is because the long-term bond can weather the recession, right? The recession will hit in 1 year, and the economy will recover in 2 years. It may recover in 2 years or 3 years, right? But the economy will bottom out anyway, right? Recession hits, but the economy will bottom out. So long-term bonds, like 10-year bonds, don't have to pay the principal until year 10. You understand? Suppose there's a long-term 10-year bond, and this company, and it's also $1 billion in total. This company sold $1 billion worth of bonds, so they owe $1 billion, and this company doesn't have to come up with $1 billion, right, until year 10. And until then, all they need to do is just pay out interest. So what does that mean? There's a good chance, there is a better chance for a long-term bond to survive this recession, right? You understand? The long-term bond will weather this recession, right? The company that sold long-term bond will weather this recession, and they will be still there, just paying out interest until recession bottoms out, and in year 10 they can cough up $1 billion in year 10, and by then economy will be back to normal, and so then think about it. Oh, how does that make inverted yield curve? Remember this mechanism. What is the return? Return is basically, okay. Think about this. Logic. It's mathematical logic. It's not really. What is the return? I mean, this is, of course, this is a zero coupon 30-year, but it will apply. Basically, it will apply also to coupon bonds. Think about it. The only difference is that this doesn't have any, income, but only capital gains. But this will make you understand why. Now, when you are dumping short-term bonds, so short-term bond price goes down. Think about it. Short-term price goes down. Short-term bond price goes down. So what's going to happen to the return? Ignore the coupon payments for now, coupon interest for now. In terms of capital gains, face value is always 1,000, right? Face value is always 1,000. So you will, at maturity, you will get 1,000, right? No matter what. But so the capital gains, as the price drops, right? as the market dumps the short-term bond, the price of the short-term bond drops. So what's going to happen to the capital gains?
It's gonna drop too.
Say them again.
It'll drop as well.
Capital gain will drop? Come on, I should give you a penalty for that. Look.
I mean, I'm thinking in terms of if the stock is worth, if the bond is worthless, what can you get out of it? Like I don't think I follow. I mean, I can guess and say the capital gains will go up, but I definitely don't get it.
You get the capital gains out of it. Think about it. The price drops. That's the selling price. Price drops. What is the face value? Face value is constant. You understand? It's constant. It doesn't change. So when this goes down, the difference becomes what? The capital gains. The difference gets larger or smaller. This is something we already did a couple of days ago. It gets
larger.
Yes, this goes up. Right? And the whole fraction. Look, this isn't about you getting anything out of it or not. This is just the math. Okay? Because that's the yield. That's the and as the numerator gets larger, denominator gets smaller, the whole fraction gets what? Whole fraction becomes, it becomes larger. And what is this? This is the return, rate of return, right? And what is another name for annualized rate of return? Yield. This is the rate of return. Remember, I only used, that example, but, there should be, coupons here, right? But I said ignore it for now. Okay? Because coupons are anyway, if the company, the company may default or not, right? May or may not. We don't know that. Just because recession hits, the probability of default may go up, but it doesn't mean it's gonna 100% default, okay? And you sold it, you don't get anything out of it when you sell it, right? After you just get whatever the price is, whatever the price is. So you may have the price you sold it for may be lower than the price you bought it for, okay, or higher. So you could have, made capital loss, but it's done. But then after you sold, the drop in price mathematically raises the yield. Mathematically raises the yield. So for example, someone who is who is betting that this company isn't going to default, for someone who is betting that this company isn't going to default, for that someone, this is a buy opportunity, isn't it right? This is a buy opportunity because the price is at the bottom. You understand very well that you have, obviously, when price falls, then that's the time to buy, of course. You have to also consider whether this is a good company and this price fall is due to a transitory factor or not. And if this is a good company, solid company, and the price falls for some misalignment of the pricing in the market, or due to some transitory reasons, that's buy opportunity. For example, because of just because there is a recession scare, or price of Apple and Amazon and Google are falling. Now, are you just because and it's because of the systemic factor. I mean, the recession fear, and a recession may not really happen or not, but for whatever transitory reasons, not for fundamental reasons, not because Google is fundamentally failing, or Apple or Amazon are fundamentally failing, but because of the transitory factors, ad hoc factors. Apple, Google, and Apple, these solid companies, Amazon, dropped by 10%, 15%. Isn't this a wonderful chance to buy, actually? When others sell out of fear, it could be a chance to buy. But I'm not telling you this is a chance. You must buy this. But from someone, for someone who bets that this company isn't going to default, right? Then this is a chance to buy. For that someone, he's gonna make a big. He's gonna reap. He's gonna reap this big harvest, right? But forget about you, or forget about that guy who is buying, who bets that this company is not going to default. Forget about that. Just look at the data. Just looking at the data, just looking at the price data. If the price goes down, the whole fraction goes up. That's why the yield is going up, right? Now, this is what happens to the short-term bond. But let's think about the long-term bond. It's exactly the opposite that happens to the long-term bond, right? 10-year bond, always think about it. The face value is always a constant. It doesn't change. It's a constant, right? But then, because people like me who sold short-term bonds are moving money into long-term bonds, 10-year bonds, what's going to happen to the price of the long-term bond? Huh? What's going to happen to the price of the long-term bond?
Increase.
Yes. I already put it there. You can just, it will go up, because there's a huge demand for long-term bonds. Now, money is moving from short-term bonds to long-term bonds. Okay. Also, money will be moving from stocks to long-term bonds as well. If there's a recession scare, right, money will be also moving from stocks to long-term bonds. Why? Because for the same reason, right? During the recession, most companies will have higher chances, higher probability. The probability of the company dwindling will go up. I mean, there's a good chance that the profit will go down, right? The stocks would go down too, so they would move the money from stocks to the long-term bond. Make sense? So there's this replacement, or a change of position in the market from short-term bonds to long-term bonds, from stocks to long-term bonds, because long-term bonds don't pay you high return, but at least they give they are safer than stocks, right? Because they pay you fixed income, right? You understand? They pay you fixed income, which is coupon, right? So as the price goes of the long-term bond, long-term, price of, that L stands for long-term, price of the long-term bond goes up, the numerator, this numerator, what happens to this numerator? What happens to the numerator as the price of the long-term bond go up? Huh?
Becomes smaller.
Yeah, it becomes smaller. And who said that?
In you?
In you?
Yes.
Okay, in you. So you get 0.025. And then since numerator goes down, denominator goes up, the whole fraction, what's going to happen to the whole fraction? Numerator goes down, denominator goes up, what's going to happen to the whole fraction?
It all goes
Becomes
down.
smaller.
It gets smaller, right? Goes down, right? Why does it take so long? And who said that? It becomes smaller. Who said that? Okay, if you don't want to take the credit, that's fine. I don't have to.
Gabriel.
Gabriel? I think that it was a girl.
I said it was around the
Yeah,
same time.
but Gabriel also said that. Yeah. It's in you.
And who else?
It's in you.
Oh, okay. In you, you got another.
And Gabriel also says that.
Yeah. All righty. You both got. So then, what does that mean? Yield on the long-term bond. So this is yield long-term, right? Goes down. Yield on the short-term bond goes up. And then, what is that? Isn't that exactly this picture? Isn't that exactly this picture? Inverted yield curve. Inverted yield curve. Right? That's why the inverted yield curve happens. It's easy to just memorize. It's a signal. Inverted yield curve signals the imminent recession. Easy to memorize it. But then after you memorize it, after the exam and after the semester is over, you forget. But if you can explain, what did I tell you? Economics and finance are all about explaining the causality relationship, the mechanism, causality mechanism. What causes why X causes Y to happen and why Y causes Z to happen, right? Being able to explain this mechanism step by step in chain reaction. This is a chain reaction, right? And it's logical. And once you know once you know why it happens, and once you can explain it in that, step by step, fashion, right? Step by step fashion. You can, if you can explain the causality, that's really, intellectual ability, right? Memorizing is nothing, right? But being able to understand, connect all these dots. Why? Mathematically, I mean, it's not, without math, this cannot be explained. And this is not even, any complex or fancy math. It's very, logic. It's straightforward logic. It's even intuitive why it is, like that. Right? You might say intuitively was hard to understand because, if the price falls, what do I get out of that? Before price fell, you already got out. Right? You understand? Falling price is the result of you getting out of that bond. You understand? That's also causality. You dumped the bond, you got out of it. That's why the price fell. Okay, so it's not what you're getting from the fallen price, you don't get anything from the fallen price. Of course, you got out of that bond, you got out of that market already before the price fell. And then that's why, as a result, the price fell, because a lot of the investors got out of this bond massively, massive number. They got out of it, right? They sold it, they dumped it. So as a result, the price fell. Okay, so okay, that's the inverted yield curve, and so that is the conclusion, right, of this topic. We only were it took 2 weeks to I've been telling you, we are already in topic 3, so you should be all caught up, right? You should be all caught up to that point. You should catch up all catch up to that point. I just wanted to before I let you go, my apologies, I have background noise. Okay, I'm so. Oh, Philia, that's okay. I don't know. Yeah, I think whenever, maybe it was you or someone else, my voice was, echoed back. My voice echoed back, and I was wondering why. And it sounded actually louder than my actual voice. No problem. So let me drop a couple of links. So we should get started on the second topic, but we're out of time. So let me just quickly. Okay, where is it?